in this live. All right. Let's get B up here. So let's do it. So by the title, we got full OCR recap with B, episode 1. I've already done classes with B on one-on-one, but today we're going to do a full recap because this video will be recorded. So whoever's watching this, you'll be able to go back and watch this anytime you want. All right. I'm about to share my screen, so give me 1 sec. B, you can hear me, right? Everything sounds cool? No issues?
I can hear you.
Okay. Let me make sure this is right. Have you turned up? All right. So let me share my screen. Let's get this moving. All right. So the first thing first, what we're going to do is we're going to go to the written mechanics, understanding what OCR is. OCR stands for Fibonacci rhythm. It's Fibonacci in confluence with swing points and mechanics. I like to teach people how to trade mechanical. I don't even really like saying I'm a mentor. I'm just more so like a mechanical instructor. Like I want people to learn how to trade mechanical. If you're not trading mechanical, I think that would just low key hinder your whole entire trading curve, your whole entire learning curve. So let's just get right into how to become a mechanical trader. The implementation needed to be mechanical. So we have the written mechanics right here. We have premium discount mechanic playbook, a natural rhythm mechanic playbook, internal, external mechanic playbook, and we have some capital preservation playbooks as well. So first things first, let's come here. Anytime y'all want to look at files, y'all will see the written mechanics area, and you can go ahead and click it from there, and then you can study these on your own time. All right. So let's do it. All right. So step number 1, marking out the range. Marking the range. So hopefully you pay attention and hopefully you're actually studying correct, because I am gonna open up quizzes. There's a I made a quiz, but it's not showing up. I don't know. It's something I gotta fix. But there will probably be quizzes I'll be making y'all take. There's a lot of tests, and the tests will pretty much be graduate type tests. So if you pass the test, you done graduated. You get a different role in the Discord, and then as the Discord grows, in the future, people will know, okay, this individual graduated. They are able to teach now. Okay, so step 1 says identify and mark the highest point of your current range, external high. Identify and mark the lowest point of your current range, external low. You're not going to understand this in the beginning. B, as you already know, you already understand it, but we're just gonna go over it for everyone else as well as for you whenever you need to go back to it. Okay. And we'll also look at the charts once we're finished with all of this. You want to set. And yeah. So identify and mark the highest point of the current range. That's your external high. Do also your lowest point. That's your external low of the range. I'm not saying overall, just of the range. How do you understand the range? You understand the range by looking at, okay, where did price start, where did price end, what made price do this, and this is the range as in, okay, my most recent highest point, that's number 1, and then the most recent swing low before that highest point was made. That's your range, okay? Then it said within this range, mark out your highest point internally and your lowest point internally. What does that mean? So within inside those two lines of the highest point and the lowest point, you mark out your highest point and lowest point within that range. Because now in order for us to get to our external highs and lows, we have to break internal highs and lows. Just off of that alone, that helps you get into breakout trades and retest trades and targets. Because if you're taking a buy off of a break of an internal high, you know that your take profit should be the external high, right? Or the most recent, the external high, exactly. Because if you do anything above the external high, then you know that your take profit is at an overbought price where sellers usually activate. So you got to be careful. Same thing for selling. All right. What is the purpose? It says this shows major buyers. This shows where major buyers and sellers are positioned and the effort required. To reach these zones. Like I just said, if you're breaking internal high, you know that we're going to an external high. If you break an internal low, then you know we're going to an external low. This shows you where the buyers and sellers are. Okay. Any external high has more sellers. Any external low has more buyers. Any internal high has less sellers. Any internal low has less buyers. All right. Step 2, internal and external structure. External structure, it says the overall market range macro perspective. Right. So that's why we use the zigzag indicator. What does that indicate? It helps us. It helps us filter out all of our lows and highs in the market. It just shows us, all right, bet this is the real high, this is the real low, because you may sit there on a smaller time frame, like the 15-minute time frame, and think, okay, this high right here is my true high. But if you actually go to the hour or the 4 hour, be like, oh shit, no, it's not. This is actually my true high. So you want to always don't really trade blind. You want to make sure that you're trading correct, and you do that by marking out your external structure first. All right. The internal structure, smaller swings within that range, micro perspective, same thing like internal and external price action of the range. You do the same thing for market structure. It said these zones help identify where the big players, institutions are entering and exiting positions. It says then it says observation. 9 times out of 10, your Fibonacci levels will align with internal and external highs and lows. All right. B, you got any questions? Or are you good?
I'm good. Can you hear me?
B, you hear me?
I'm good. Can you hear me?
Hold on. Let me make sure. Yeah, I hear you now. All right,
Okay.
good, right? You can hear me?
Mhm.
Okay, cool. Just making sure, because I don't want to come back and be like, damn, I wasn't even recording.
Oh no, you good?
All right, for sure. How do I move this out the way? Okay, whatever. That is eternal. Let's go back to it. Hold on. How do I move this? Okay, there we go. Back. Boom. And now we got step 3, understanding highs and lows. This is very simple. Highs are meant to be broken. It says indicates buyer pressure is strong enough to push price higher. Lows are meant to be broken. Indicates selling pressure is strong enough to push price lower. A broken low pretty much means you're on buyer's territory, but the sellers have potential to push price lower. I'm gonna say that again. This is the fight that we have internally that's correlated with the market, because it's like, damn, if price is breaking lows, we know that the sellers have control, but the lower we go, the more we enter buyer territory, because you want to buy low and sell high. Same thing inverted, the opposite way. So I'm gonna say that again. Broken low. It says market, if the lows are broken, the market is now in buyer's territory, but sellers have potential to push price lower. And then if for broken highs, market is in seller's territory, but buyers have potential to push price higher. All right. And then it says key mechanic. It says key mechanic. Every break tells you who is in temporary control, who is temporarily in control, and who has potential to act next. All right. Take a sip of this water. All right. And then it says step 4, identifying big players. External highs and lows, where institutions and large buyers and sellers have historically been active. Internal highs and lows, where medium-sized participants or smart money manipulate short-term moves. Why it matters? Knowing these levels allow you to anticipate reacts, breakouts, and retests will occur. All right. So that's step 4. That's just perspective for you. Step 5, correlation with Fibonacci levels. Y'all don't understand Fibonacci yet, but we're going to get into that today. Correlation with Fibonacci levels. External highs and lows often correlate with Fibonacci retracement and extension levels. And then it says these alignments will create high probability zones for entries and exits. Step 6, execution logic. So this is the exact sequence that you should apply this. Step 1, mark external highs and lows, your macro range. Step 2, mark internal highs and lows, your micro swings. Step 3, identify territory, buyers and sellers. B, you already know what that looks like, and we mark out our red box, black box, and our green box where there's buyers and sellers. Cool. Identify territory, buyers and sellers. Broken low, identify buyer territory and where sellers have potential. Broken highs, we're in sellers territory, but buyers have potential. Step number 6, watch for price reaction at these zones. 7, confirm setup with internal and external structure and Fibonacci alignment. 7, enter trades with clear understanding and who is in control and potential counter pressure. All right. So those are just the steps. It may seem like a lot, but you literally do this simultaneously every day in the moment. So it's gonna become second nature. And yeah, that's just that. So that's breaking down internal highs and lows. That's all of these steps. This is all the steps, but this is really step number one to everything else that we're gonna be doing. It's not hard. It's not difficult. It's just something that you got to do. All right. Like I said, you'll be able to look at these whenever you need. Um. So yeah. Now we're gonna come here. Premium and discount price. Let's understand this. Step number one. Take a sip of this water. Damn, I'm thirsty. Ah man. All right. Premium and discount mechanic playbook. All right. I wish I was in a whole group with hella people. I would be asking people what y'all think that mean. So premium and discount. There's gonna be so many ways I say this, but they all mean the same thing. It's premium and discount, supply and demand, overbought, oversold, cheap, expensive, support, resistance. It's all the same thing. However you want to say it, it don't matter. It's all the same thing. I just want to put that out there so you don't get confused. So, core principles. It says price moves because of supply and demand. Outside of price, even in today's world, even with stores, what moves the economy is supply and demand. You have too expensive, overbought, which means the sellers dominate, price drops because it's too expensive. Too cheap, that means it's oversold. Buyers dominate, prices rise. In visual presentation, we're going to be drawing out a red zone. A red zone means overpriced, premium, resistance, expensive, whatever you want to call it. Green zone means undervalued, discount, support, and really cheap. Okay. Step two, understanding overbought and oversold. It says, I'm not even going to go over this too much because I low key just reiterate the same thing damn near every step
Mhm.
to put it in perspective. But I'm probably going to go to like step five and that's it. But
Okay.
step two, it says, when an asset is overbought, demand is exhausted and sellers will push price down. When an asset is oversold, supply is exhausted and buyers will push price up. For an example, one, a stock jumps rapidly and becomes overvalued compared to its average trend. Price will likely retrace. So, for example, if you let's say your favorite store is Bath and Body Works, right? Boom, Bath and Body Works, and you know that this specific, you come here every time, you come here every 3 weeks for this specific body wash, and the typical price of this body wash is $7. And you're like, all right, bet it's $7 for a 16 ounce. Bet, cool, I'm gonna get it. But then you go again one day and it's like it's like $13 now. It's damn near double the price. And you like, I don't even know if I really want it no more. So you're like, all right, bet. I don't even really want it no more. So now it's oversold. I mean, sorry, it's overpriced. It's overbought. People bought it a lot, but now they raised the price too damn much because they was being stingy. They wanted to make more money. So now nobody's doing it. So now what? They gotta lower the price now. They lower the price. They lower the price. Now let's say, for example, it gets real cheap. You go in there one day and it's $3. They having like a 70% off sale, and it's $3. That's gonna push price up because now, boom, people are buying. They're buying. They're buying. They're buying. They're buying, and that eventually will push price up. So all the market is doing is rebounding off of each other. As of right now, it's not the market has been buying crazy, but inside of these ranges, that's exactly what it does. The market is a mechanic. I'm not a mechanic. The market is an algorithm, and we're the mechanic. We dissect the language. We're over here taking out the tools, and we're trying to understand what's going on. The whole time is doing the same thing every day, just from a different perspective. And you got to be able to understand every perspective so that you can execute every day. All right. So that's that. Example number two, a cryptocurrency dips far below previous levels, buyers see value and price rebounds, goes back up. All right. Step number three, expensive to too cheap concept. Expensive means red, premium zone. Price is too high relative to buyer's willingness means selling pressure. Cheap green, discount zone. Price is too low relative to seller's willingness. That promotes buying pressure. Example one, I don't really got to get into the example. You get it. Expensive, cheap. And then you have auction zone, breakout slash fairgrounds. So you have the black zone. The market don't like this zone because nobody's making money.
Mhm.
Nobody's making money. It's just very stagnant. You can make money, but it's like, it's not trending. So black zone equals a fairgrounds, auction, or even break even. It says neither buyers nor sellers dominate. Institutions avoid taking positions here because no profit is made. For an example, Stock fluctuates around an equilibrium price with small trades. No clear direction until it breaks premium or discount zones. Overbought or oversold. Step number 5, multiple perspectives, same mechanics. Perspective number 1, trading. Buy low, green, sell high, red. Avoid the break even, which is black. Perspective number 2, real life. Overpriced items sell slower. Underpriced items sell faster. Perspective number 3, market psychology. When everyone thinks price is too high, sellers emerge. When too low, buyers emerge. Perspective number 4, institutional behavior. Institutions target premium and discount zones for predictable entries, avoiding fairgrounds where no edge exists. All right. And that's just that. I don't even gotta get into much. Yeah. Hopefully you understand. You understand that, B? Or any
Yep,
questions?
I'm good.
All right.
Mm-mm.
Bet. And now a natural rhythm. Now let's get to the bread and butter. This is the bread and butter of everything.